Ask most people what a bond is, and you will get one of three responses: a blank stare, a vague answer involving the government and interest rates, or a confident dismissal. Bonds are boring, bonds are for old people, bonds are what you own when you have given up on real returns. Every single one of those responses is a signal of the same thing: a gap in financial understanding so significant that it affects how those people think about interest rates, inflation, recessions, central bank policy, and the behavior of every other asset in their portfolio. Because bonds are not just a conservative investment option. They are the backbone of the global financial system. They are the mechanism through which governments fund themselves. Central banks control the economy, and institutional investors move trillions of dollars across markets every single day. Understanding them is not optional for anyone who wants to genuinely understand money. My name is Tomas, and this channel is about finance, automation, and building real financial literacy from the ground up. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are making bonds completely clear: what they are, how they work, why they matter, and how understanding them changes the way you see every other financial decision you make. Let's get into it. Let us start at the beginning, because bonds are one of those financial concepts that almost everybody has heard of and almost nobody has had explained simply enough to actually understand what a bond actually is, stripped of all the jargon. A bond is a loan. That is it. When you buy a bond, you are lending money to whoever issued it, a government, a corporation, or a municipality. And in exchange, they promise to pay you a fixed interest rate, called the coupon, at regular intervals, and to return your original loan amount, called the principal, at the end of a defined period of time, called the maturity date. A simple example makes this concrete. If you buy a 10-year United States Treasury bond with a face value of $1,000 and a coupon rate of 4%, the U.S. government promises to pay you $40 per year for 10 years and return your $1,000 at the end. The government is the borrower. You are the lender. The bond is the contract between you. Why bond prices move in the opposite direction of interest rates, and why this matters enormously. This is the relationship that most people find confusing, and that once understood, unlocks an enormous amount of clarity about how financial markets work. Bond prices and interest rates move in opposite directions. When interest rates rise, existing bond prices fall. When interest rates fall, existing bond prices rise. Always. Without exception. Here is the logic. You own a bond paying 4% annually. Interest rates in the broader economy then rise to 6%. New bonds being issued now pay 6%. Your 4% bond suddenly looks less attractive to any potential buyer. So if you want to sell it before maturity, you have to sell it at a lower price to make the effective yield competitive with the new 6% bonds available in the market. The price of your bond falls until the yield it offers matches what buyers can get elsewhere. The reverse is equally true. If interest rates fall to 2% and your bond still pays 4%, your bond becomes highly attractive relative to newly issued alternatives. Buyers will pay a premium above its face value to own it. The price rises. This relationship is why bond markets react so dramatically to central bank interest rate decisions. Every time the Federal Reserve raises or lowers rates, the price of every existing bond in the market adjusts immediately to reflect the new rate environment. And because the bond market is significantly larger than the stock market in terms of total value, these movements have cascading effects on every other asset class, including equities, real estate, and currencies. The yield curve, the single most predictive indicator in all of finance. The yield curve is a chart that shows the interest rates on government bonds of different maturities at a single point in time. Normally, the curve slopes upward. Longer-term bonds pay higher rates than shorter-term ones because lenders demand more compensation for tying up their money for longer periods and accepting more uncertainty about the future. When the yield curve inverts, when short-term bonds pay higher rates than long-term bonds, it is one of the most reliable recession indicators available. An inverted yield curve has preceded every U.S. recession in the last 50 years, typically by 6 to 18 months. The reason is intuitive. When investors are willing to accept lower returns on long-term bonds than short-term ones, it signals that they expect interest rates to fall in the future, which usually means they expect economic growth to slow and the central bank to cut rates in response. Understanding the yield curve means understanding something that most retail investors never pay attention to, a forward-looking signal about the direction of the economy that is embedded in the daily pricing of government bonds and updated in real time. How bonds fit into a real investment portfolio, and why ignoring them is a mistake at any age. The conventional wisdom that bonds are only for conservative or older investors is one of the most persistently unhelpful pieces of financial advice in circulation. Bonds serve a specific function in any portfolio. They reduce volatility, provide income, and tend to appreciate in value during the economic downturns when equity prices are falling most aggressively. That function is valuable at every stage of an investing life, not just in retirement. The classic 60-40 portfolio, 60% equities, 40% bonds, has outperformed pure equity portfolios on a risk-adjusted basis over most historical periods, not because the bonds generated higher returns than stocks, but because the smoother ride allowed investors to stay invested through downturns, rather than selling in panic. The investor who holds through every correction because their portfolio is less volatile than a pure equity alternative builds more long-run wealth than the investor who holds 100% equities but sells at the worst possible moment during a crash. In 2027, bonds are generating real yields again after a decade of near-zero rates. A government bond paying 4 to 5% is no longer the irrelevant asset it was in the previous decade. For investors with medium-term goals, for those building a buffer against equity volatility, and for anyone who wants their portfolio to behave predictably during the next recession, bonds deserve a genuine place in the allocation conversation. So there it is, bonds explained clearly, completely, and in a way that actually connects to everything else in the financial world. A bond is a loan with a fixed coupon and a maturity date. Bond prices move opposite to interest rates, always. The yield curve is one of the most reliable leading indicators of economic recessions available to any investor paying attention. And bonds belong in a serious investment portfolio not as an afterthought, but as a deliberate tool for managing volatility and generating real income in a world where they are finally paying meaningful rates again. Understanding bonds is not just about bonds. It is about understanding how central banks move markets, how recessions develop, and how the entire global financial system actually functions. That understanding makes every other financial decision sharper. If this video finally made bonds click, please hit that like button. It genuinely helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.